Stagflation, the worst of many worlds. Economic stagnation, high inflation, and rising unemployment. Stagflation historically leads to lower returns on investments. So what can you do to protect yourself and your wealth? With prices still elevated, high interest rates, and the mounting national debt, the present and future purchasing power and cost of living of everyday Americans is more and more uncertain. If you think that you may be falling short of your retirement goals, see the link in the video description to the free inflation and retirement calculator. Also, see the link to the full article in the description below. Silver performs well in periods of economic stagflation because it trails the value of gold, and because many investors exit the standard publicly traded investments like stocks, bonds, and other paper assets looking for safety and stability. When stagflation sets in, inflation gets sticky, and as the central banks continue to tighten or pause, tangible commodities such as precious metals, base metals, are a more reliant place to park your investment capital. Some of the warning signs leading up to stagflation: silver starts to outperform gold, and long-term bonds are outperforming equities. During a typical recession, industrial production slows down due to negative growth. As a result, the demand for silver decreases. However, in periods of high inflation, silver maintains its value. Even though silver is an industrial precious metal, the wheels of industry may slow, but they simply can't stop. Evergreen industrial demands, such as medical applications, electronics, automotive components, and green energy products for solar power, will continue to drive demand for silver. Solar power alone represents 12% of the total demand for silver, not just the industrial demand. This is quite significant given the expanding demand and popularity of solar technology. Also, whether we like this fact or not, federal government spending on infrastructure and green energy investments do not appear to be going away. The massive infrastructure spending bill, ironically titled the Inflation Reduction Act, directs $370 billion to green energy transition projects. As we all know, when the U.S. Congress commits to spending money, they keep their word. The American investor, whether they agree with these policies or not, can at least invest in the commodities that will appreciate as a result. The 60-40 portfolio, this basic diversification strategy of 60% stocks and 40% bonds, was a relatively safe and passive way to invest for the last 15 to 20 years, particularly when the Federal Reserve was injecting liquidity into the market. However, the flaws of this model are revealed during times of economic turbulence. The S&P 500 fell 40% during the stagflation event of 1974. U.S. Treasuries and government bonds gave negative returns when adjusted for inflation. Since this type of portfolio is limited to two asset classes, stocks and bonds, the 60-40 model is not true diversification. In times of stagflation, real assets, or sometimes known as hard assets such as commodities, are the best performing assets. History does not repeat but rhymes, and if past is prologue, then our last analog for stagflation is the 1970s, for which the U.S. experienced multiple waves of inflation. Each successive wave was more violent than the last. The Federal Reserve is using the same tools as in the 1970s, quantitative tightening. In the 1970s, the Federal Reserve applied these tools in a more aggressive way, resulting in double-digit interest rate hikes. This was a painful period for the average American and investor. This next possible period of stagflation could be even longer. There is a big difference between the 1970s economy and our present one, the main one being the nation's national debt to GDP ratio. In the 1970s, the U.S. debt to GDP ratio was 32 to 35%. At present, the United States debt to GDP ratio is 123%. Bear in mind, the Federal Reserve during the 1970s had to raise interest rates to double digits. In retrospect, the ability for the U.S. government to service the national debt during the massive interest rate hikes in the 1970s and 80s was far easier than our present economic environment, and that is just the national debt. Household and corporate debt is in for the same shock as those rates roll over. As the Federal Reserve Chairman stated many times in 2022, there's going to be pain. Silver is an excellent hedge in good times, but a crucial hedge in stagflation times. Historically, silver and other precious metals stand strong against these challenging economic headwinds. The forces facing the U.S. as well as the world are far more intense than they were in the last stagflation cycle of the 1970s and 1980s. Precious metals are essentially wealth insurance against losses that are felt elsewhere. Silver and other precious metals won't go bankrupt on you, and central banks cannot print more or manipulate its supply. To learn more about gold and silver investing, see the links in the video description to access the many gold investment guides from the best gold IRA and precious metals investment companies that we have personally researched and vetted. Get started today by attending a free gold and silver educational webinar from Augusta Precious Metals. Click the link in the video description. Please like and subscribe if you enjoyed this content.